makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Wall Street caught off guard as hotter than expected U.S. inflation deals a blow to the Fed rate cut hopes. Some relief for the Bank of England as UK prices rise less than forecast in January, with downward trends in food and household goods bolstering bets that inflation could soon return to target. Plus, Heineken slumps after the world's second biggest brewer warns persistent inflation and economic worries will weigh on beer demand. So let's take a look at the European markets map. Of course, a lot of the focus on what we heard from the U.S., the American CPI print coming in as a disappointment for investors after a recent downdraft and price pressures that really helped build that expectations of Fed cuts. This is a picture for Europe for the moment. So you can see the FTSE gaining some 0.3%, the CAC 40 0.1% higher. We did have better than expected news out of the UK. Again, if you look at the pricing, for example, for easing in the UK, they've brought that forward by, of course, the Bank of England. Inflation in Britain came lower than forecast in January. Then we look at a couple of the earnings stories. I know we have Heineken. We have also others in Europe. So it'll be really interesting to see how that plays out across the board. Now, to talk about inflation, talk about Fed cuts and monetary policy, we're joined by Noor Al-Ali from Bloomberg's MLive team. Also joining us is Marija Veitmane, senior multi-asset strategist at State Street Global. So thank you both for joining us. Noor, this is as expected, but not as expected, because the market got ahead of themselves. But central banks kept on saying, like, look, let's wait and see for data points.
Yeah, and central banks have been saying that for quite some time, and it's just a matter of the markets playing catch-up. But Francine, I think if we want to take a step back here and just realize for a second what the inflation data that's been coming out of the U.S., out of the U.K., and the wages is really telling us that life is not really linear, right? We're looking at these data points, but in reality, we're looking at an economy that's really trying to get a grasp of itself. We also know that the last mile of inflation is notoriously quite hard to get a hold of. So, you know, if you're looking at today's data, you saw that housing and household services were the largest contributors to that inflation print, but that's largely driven because of higher gas and energy costs. So that's the inflation resurging that we were talking about in the fourth quarter starting to materialize now. So if I'm talking about what's happening now, ECB's Guindos just came on the tape and said, look, yes, we are data dependent, but maybe it's also time for us to start looking at these projections and seeing where that inflation is headed. And in the UK, it looks like it's going all in the right direction.
Let's stick to the US for now. So, Maria, when you look at US expectations, and it's, there's a debate on whether that last mile to get inflation down is tough or not. Like, where are we on that? And how much has inflation coming down been thanks to monetary policy action?
I think for us the distinction is very much between goods inflation and service inflation. And we know goods inflation, when Fed was talking about transitory inflation, that's really talking about goods. And we saw a huge spike a couple of years ago, it came down, now goods inflation is gone. Where we see inflation is services area, right? And services are strong, they're driven by labor market, and labor market is, it's slowing, but it's still very robust. So to us, yesterday's report was really vindication of what we've been talking for a while, is that service inflation is still a problem. So if Fed is really serious about bringing that down, then we need to see tighter financial conditions for a bit longer, and potentially higher chances of recession. So unfortunately, there is to us, it's very difficult to see this kind of soft landing story.
But so, Maria, if you look at what we heard from U.S. inflation, what we saw for U.S. inflation data yesterday, coupled with actually that strong jobs number in the U.S., how quickly, we also had Jeffrey Gundlach saying, we wouldn't see any cuts from the Fed before June at the earliest, if at all. Like, do you agree with that?
Yeah, I think we will lean that way as well. And again, that all comes back to the strong labor market. And it's really hard to see how Fed can justify being cutting rates very aggressively if labor market is that strong. So, for us, we would lean towards higher for longer.
What surprised you the most, Nora, about the U.S. economy in general?
I think it's that Goldilocks narrative that we keep touting and getting retested. Yesterday's inflation data showed us, as we've just heard, that there is still a lot for the Fed to do. And we've had, Fed's goals view that's going to come out later today, who's probably going to highlight that, And the Fed has constantly pushed back on the very aggressive market pricing that we've seen. And, ultimately, it really doesn't matter where the market, looks at the rate expectations day in and day out. Ultimately, it's a much longer horizon. We are expecting the Fed, the BOE, and pretty much all major developed central banks to start cutting rates sometime soon, sometime this year. We are pushing that timeline. But still, inflation is still a problem. And we don't want to see a repeat of that, 1970s episode where we still had that inflation continue for decades while, it was still much higher. So, if it means that the Fed has to keep, tighter reins on monetary policy, then so be it, until a time where we see that inflation problem dissipate.
Marija, I want to ask you about U.S. earnings in a second, but are a lot of stock markets actually priced to perfection, given what we've heard in terms of the inflation trajectory?
I'll probably have to still kind of bring earnings in. And for me, there's a key, stock market is really very bipolar element. We have Magnificent Seven, we have everything else. In terms of performance of the stock market, but equally we have exactly that in terms of earnings. My favorite stat from earnings season is Q4 earnings growth in Magnificent Seven stocks. That kind of blended estimate is plus 50% year-on-year growth. For the rest of the market, minus 10. So that's really the divergence, and that's kind of what's happened, divergence in earnings, and that's exactly what we see in terms of that divergence in performance of those stocks. So yeah, I'm not sure the whole market is priced for perfection, but I think there is a lot of justification in kind of market internals given the earnings backdrop.
Let's also talk about UK inflation. Of course, that came in below forecasts in January with downward trends in the cost of food and household goods. Consumer prices rose 4% compared to a year earlier, the same pace as in December. Now, the UK Chancellor Jeremy Hunt says the government's plan to bring inflation down is working.
Inflation never falls in a straight line. And although it's welcome that it hasn't gone up today, it is still double the target level of 2%. And we're not going to be able to relieve pressure on families until we hit that target and the Bank of England feels able to reduce interest rates. So this is a time to stick to a plan that is clearly working, but we need to make sure that we really get to that end point of inflation at 2%.
Now, for more on this, we're joined by Anna Andrade from Bloomberg Economics. So, Anna, give us a little bit of a breakdown of the data that came out this morning. Does it really make the Bank of England's job a little bit easier?
Hi, good morning. Yes, we think it does. Sorry, just had some problem with the audio. We think it does.
We can hear you, Anna.
Yeah. You can hear me? Okay, fine, sorry. We think it does improve the job of the Bank of England. Essentially, it's still sticky. The headline number is still sticky, but we got some positive news on services. Services was 6.4, it ticked up to 6.5, but the BOE was actually expecting it to tick up to 6.6%. So that downside surprise is good news. And the important thing and the message that we got from the Bank of England in the February meeting was that it was open to the idea of significant policy easing as long as inflation played ball, as long as it came broadly in line with its forecasts. That's what we had today. It's still on track to undershoot the 2% target by the spring. So it still looks like we'll have significantly easing this in policy this year.
So what does that mean for what the Bank of England does next? I know there was a very cautious Governor, Andrew Bailey, in saying, look, let's wait and see. They're not in any hurry. And at the same time, March 6th is also the budget. So that could bring extra inflationary pressures to the UK.
Yeah, that's right. And that's why we've been saying for a long time that May is the earliest possible window that the BOE will have to cut rates, because we'll have the spring budget on the 6th of March, and it won't to see the outcome of that. So we had Jeremy Hunt, the UK Chancellor, doing a lot of tax cuts in the autumn statement, but they weren't inflationary because they focused a lot on income tax. And that also has an effect that it brings more people back to work. It increases supplies in a way it's not a threat to inflation. And the big question now is whether he will continue to focus on this sort of tax cuts, so focusing on the NICs that has, positive effects on labor supply, or if it will do something else. We think that his main priority is actually not to derail the easing cycle of the BOE. So I think that's what he'll be focused at. So we're not actually expecting a lot of significant policy stimulus coming out from the spring budget, nor a lot of added inflationary pressure.
Anna, thank you so much. Anna Andrade there from Bloomberg Economics. So let's get back to Marija and, of course, to Nora. Marija, when you look at some of the opportunities in the UK, we also have an election in the next 12 months. I don't know whether it seems like a good place to be for investments.
Yes, in a sense, yes. I mean, what we like about UK in general is that it's very defensive market relative to kind of overall benchmarks. So our kind of overall general outlook on the market is somewhat cautious. So UK kind of ticks quite a lot of boxes. Like in UK, we particularly like healthcare stocks. So there are quite a few very large healthcare stocks that have decent kind of earnings pipeline, a strong cash flow. So those type of things that we particularly like. It also has a benefit of not having many cyclical stocks, something that is kind of dogging European market, where we would be more underweight. So yeah, prefer UK to Europe. I think that's a reasonable way to think about it.
And Nora, what does that mean for Jolt?
Well, look, I mean, they've really rallied in the recent months, right? And we've seen them also rallying now. And, they've taken back some of those gains. Gilts, the yields curve is still inverted. So there's still an expectation in the bonds market that we are somewhat in a recession. We are headed towards one at least. We've got the GDP data that's still due. It's going to give us some, inclination on where the economy is at the moment. And that's going to have a big factor to play when it comes to the Treasuries market. And in relation to that as well, the gilts market as well, because, they're all, it's all about rate differentials now. Who starts cutting rates first, and whether the UK, the pound gilts can benefit from a delay or an expected delay out of the Fed if the BOE starts first.
Nora, thank you so much. Nora and Marija, both stay with us. Marija Veitmane, Senior Multi-Asset Strategist at State Street, and Bloomberg's Nora Ali. Now, we're also looking at Lyft pre-market, those shares surging as much as 67% in U.S. extended trading before falling back to earth. Well, I'm not sure about falling back to earth. They're still gaining some 17.8%. The ride-hailing company issued a massive correction to its margin outlook, saying it expects growth of 50 basis points this year, not the 500 basis points in an earlier press release. Now, much more to come, and this is Bloomberg. Well, still with us, Marija Veitmane, Senior Multi-Asset Strategist at State Street. Marija, thank you so much for sticking around. Now, we were talking a little bit about where you see the best opportunity. I don't know what you've learned actually in the earnings season. It was a little bit uneventful, which is good news. And some companies in certain sectors really did all they could to just give money back to investors through dividends and share buybacks.
No, that's definitely true. And I think before earnings season, we were talking about kind of stability of earnings, about ability to protect margins. And that seemed to be really differentiating factor kind of post earnings seasons, and companies who are able to do it. And like you mentioned, dividends and buybacks, those companies tend to do better. I mean, majority of those, as I mentioned, are in tech sector. I mean, a bit of like healthcare, maybe energy looks a little bit better. There are quite significant disappointments, mostly in cyclical areas. And to us, really important factor has been margins. So margins is a real problem. We see companies, there are bigger sales growth than earnings growth. So margin had been squeezed for companies to be able to kind of generate those sales. So that's a real concern, especially as earnings expectation for the whole year are still double digit. So for us, that's particularly kind of optimistic. So we're really looking for companies who are able to protect their earnings, let alone grow them.
And so, Marija, is that in certain sectors? I know you worry about financials, but you're also looking at healthcare.
Yeah, no, financials, that's our kind of pet hate. Financials, it's interesting that we had last year arguably was one of the really good conditions for financial sectors. Interest rates were increasing, margins were rising, companies were still lending. And now we see really all those headwinds, all those tailwinds turning into headwinds. Interest rates are coming down, lending is really slowing, provisions need to increase. We see investment banking revenue slowing, so it's really tough times for financials. Like looking ahead, healthcare is almost opposite. Is that they're able to generate strong free cash flows, earnings look a little bit better, and we also know from institutional investors that the positioning in healthcare stocks is really low. It's traditionally investors kind of shy away from healthcare stock in election years, but I suspect this year is probably elections are going to be fought on quite different agendas other than kind of drug prices. So we see opportunity there.
So, Marija, is there anything else? I don't know how you read China at the moment. So, for the moment they're on holiday. And, of course, when it goes back to business, it'll be a good understanding of how consumer behavior has, happened actually in the Lunar New Year.
Yeah, no, I think it's an important point. But I think in general, Chinese authorities obviously spent all of January and like the back end of last year trying to support market. We had a very difficult performance last year, quite a lot of policy announcements. But unfortunately for us, majority of those policy announcements were stock market related. So you look at like short selling bans, which ultimately never work, or things like putting more sovereign wealth money into stock ETFs and things like spending like trading hours and northbound connect. So all those things that are stock market related, they don't really address the kind of fundamental problem. And to me, the fundamental problem in Chinese stocks, if you look at last 10 years, MSCI China earnings have gone down 25%, while the rest of the world earnings grown 50%. So that's really fundamental, that companies are struggle to make money, regulatory regime is difficult. So I think that's really not a market for kind of long-term investors to come in. We know investors are underweight, it's cheap, but it's really the policies we heard, policy kind of initiatives, they're really not supporting the real kind of fundamental problems that Chinese market having. So we would stay away. We think it's a trader's market. It's not really long-term investment market.
So interesting, Marija. Thanks so much. Marija Veitmane, their senior multi-asset strategist at State Street. Now, coming up with some of the biggest Dutch companies reporting today, we also look at what they tell us about consumer demand and behavior. We'll discuss Heineken's miss and a beat from Ahold delays. That's up next, and this is Bloomberg.
Balanced revenue growth is important, with a good balance between volume and pricing. Last year, indeed, it was predominantly driven by pricing. That was out of necessity due to very strong inflation on our input cost. We have started seeing that decelerate already in the second half, and much more moderate input cost inflation in the new year. Consequently, much less pricing, and therefore we do believe we will be able to generate more balanced revenue growth.
That was Dolf van der Brink, the Chief Executive Officer of Heineken, speaking earlier on Bloomberg Markets today. And that's as the world's second biggest brewer warns of economic troubles that will weigh on beer demand through 2024. Now let's get more of those earnings from Heineken and fellow Dutch-listed company Ahold Delhaize. Bloomberg's April Roach is in Amsterdam with all of the details. April, good morning. So what can you actually say about current consumer demand based on both Heineken and Ahold?
Good morning. Yes. So, firstly, looking at Heineken, overall, the company sold less beer last year due to high inflation and challenging business conditions. And if we look at the firm's outlook, it provided a very cautious outlook going into 2024, as it expects that slowdown in consumer demand to continue to weigh on its beer volumes in 2024. So it's expecting those negative trends to continue going into this year. Whereas if we look at Ahold Delhaize, they're also quite a cautious outlook. The company kind of reiterated its historical target for its adjusted operating margin for 2024. said that it's quite proud of this achievement, that it's able to maintain its guidance and expects a kind of similar performance year on year. So again, as well, Ahold Delhaize, that big sort of retailer, is being quite cautious on its outlook going into the year.
So what can you tell us about the differences in domestic or European markets versus overseas markets when it comes to these consumer-facing companies?
Yeah, so in Heineken, we saw there were some difficult weather conditions over the summer last year that really impacted its results. And for Heineken, analysts were really focusing on how it would fare in its key Asian markets like Vietnam and Cambodia. And the answer, if we look at the results, is that these markets remain challenging. Heineken said that the decline in beer volumes in Vietnam, but also Nigeria, accounted for 60% of those volume declines in beer. So those markets are really continuing to drag on its profitability and remain challenging. If we look at Ahold Delhaize, we know that the retailer has been facing multiple headwinds in the U.S., and that's due to the restart of student loans and also the U.S. government unwinding its SNAP benefits program, as well as higher interest rates. All of those factors combined really put pressure on Ahold Delhaize's margin in the U.S. However, with this 4Q update, we saw that the U.S. market actually performed better than expected, and this was able to help boost results. Also in Europe, Ahold Delhaize said its volumes turned positive for the first time in 2 years. So in both markets, they actually saw some positive.
April, thank you so much. April Roach there with the very latest on consumer behavior. Coming up, the latest from the Middle East. This is Bloomberg. Well, Wall Street caught off guard as hotter than expected U.S. inflation deals a blow to Fed rate cut hopes. Some relief for the Bank of England as UK prices rise less than forecast in January, with downward trends in food and household goods bolstering bets that inflation could actually soon return to target. Plus, Heineken slumps after the world's second biggest brewer warns that persistent inflation and economic troubles will weigh on beer demand. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So officials in Egypt are reportedly making progress on a ceasefire and hostage release talks in the Israel-Hamas conflict. Sylvia Westall, Bloomberg's managing editor for economy and government in the EMEA region, joins us now. Sylvia, thank you for joining us. You're in London today. You've been following this extremely closely from the very beginning. It's unclear to know where we are. We count the number of civilian deaths. And actually, are we closer to a hostage release?
Well, I think we can talk about this as another kind of tipping point in what's been happening since the October 7th attacks on Israel. Right now, the Israeli military is pushing up towards the Egyptian border in this offensive, and they're planning to enter the southern city of Rafah, which is close to Egypt. And that's where about 1 million civilians are sheltering, and where they've been moving through the Gaza Strip since this offensive started. So I think there's now Israel wants to finish the military operation. Its aim is to completely destroy Hamas in Gaza, and it says that there are battalions that are in Rafah that they need to target and they need to eliminate as part of this. But this is an area where all the civilians are. There's increasing pressure on Israel to slow this, to make sure it protects civilian lives, and also to enter into these ceasefire talks and try to come up with an understanding that means that these hostilities can at least pause to get civilians out.
But there was a big report, I think, from Amnesty International. There was a big report from also the UN. The U.S. seems to be telling Israel to temper down the way in which they pull out these attacks. Are they listening?
I mean, the US and Israel would say that it has been trying to protect civilian lives. The US would say it is having influence. The view from the rest of the region is very different. You've had remarks by Jordan's king. You've had other countries in the region saying that, even Biden himself saying that the military offensive has gone over the top. Netanyahu said he didn't understand what Biden meant by those comments. So I think you are seeing real frictions between the US and its main ally in the Middle East right now.
But how problematic is it for the U.S.? I mean, if they want Prime Minister Netanyahu to stop civilian casualties, do they actually pull aid out of Israel, and would that make a difference?
And that's one thing that some critics of what's been happening have been saying is an option. I mean, right now what we're seeing is that Israel has moved and it's into its last phase of its offensive in Gaza with this end goal, and it's pushing forward. And it's really very difficult right now to. I think that's why the pressure has really increased on these ceasefire talks, and why we're seeing increasing leaks about progress. I think, the different sides would talk about progress or not. It's all being mediated by Qatar and Egypt. And, it's very, very delicate negotiations happening right now. They have had success in the past, where they have had a pause of a certain period of time. But right now, I think the stakes are raised on all sides, which is why this particular round is especially difficult.
So would Egypt or other bordering countries actually take some civilians?
It's been really difficult. I mean, there have been suggestions that, Egypt should take in large numbers of Palestinians, but Egypt completely rejects this. It says it's thinking about its own security, its own, peace agreement with Israel, and also that if they do this, then what happens to this idea of a Palestinian state in the future? So I think this idea, is the longer-term thing that everyone is looking at. In some ways, this is a tipping point into disaster, but others might argue it's, it could actually mean that this is an opportunity to actually try to head towards a Palestinian state. But it just doesn't look like the US and others have the leverage to do that right now.
The U.S. also seems extremely uncertain. I mean, they're still sending weapons and money, of course, to Ukraine. And then we had this, frankly, bizarre statement from Donald Trump in a rally saying that actually he would encourage Vladimir Putin to do something in countries that don't pay their dues to NATO. I mean, where will that go?
Well, I think now what we're seeing is U.S. domestic politics affecting, policy in the rest of the world. We often, I work in, look at Russia, Africa, Middle East. We often talk about domestic politics in these countries affecting how they react in the global order. But right now we're seeing the U.S. is having the same issues. So I think right now we're seeing that this debate on Ukraine, on Russia, on Israel, on all these other things, this debate in the U.S. is sort of filtering through to U.S. foreign policy. And Trump, as the front-runner, Republican front-runner, is really playing into that. And it's an opportunity for critics of the U.S. and critics of others to seize the moment, like Vladimir Putin.
How much is actually happening on the ground in Ukraine at the moment? Is Putin just biding his time in case, Donald Trump becomes president?
Yeah, it's a tricky one to sort of assess. What we know is that we've reported that, Russia's sent some curious signals to the US that it's willing to have talks and discuss certain parameters of what that might look like. US officials say, they reject this. They say nothing has happened of the sort. And they say that, Putin is trying to sow divisions amongst Ukraine's allies. What we can say is that is happening, that there is an attempt to sort of sow divisions. And Ukraine has been dealing with its own turmoil, both domestically and on the battlefield, where things are at a stalemate. So it's a really volatile time right now leading up to the elections later this year.
Sylvia, thank you so much for joining us. That was, of course, Sylvia Westall, Managing Editor for Economy and Government in the region. Now, House Republicans have voted by the narrowest possible margin to impeach Homeland Security Secretary Alejandro Mayorkas after a failed attempt last week. Well, Mayorkas becomes the second cabinet member in U.S. history to be impeached. However, there's little chance that the Democratic-led Senate will vote to convict him and remove him from office. Coming up, Bloomberg understands that Standard Chartered is weighing a major revamp to boost returns. We have the details on this and much more next. This is Bloomberg.
Gradually reducing this year from around to 49% to around to 40%. So it will be good that at the same time we will be in the market with our share buyback. They have also said that again they want to participate pro rata in our share buyback. So that's also the indication that they stick to their agenda despite having a caretaker government in further reducing the stake in ABN AMRO.
Well, that was the ABN AMRO chief executive there on the Dutch government selling part of its stake via the company's share buyback. Now, the company is one of the biggest risers this morning on the stocks, on the Euro Stoxx 600, after beating estimates in the fourth quarter. Now, Spanish lender Santander says a review into accounts held by an Iranian petrochemicals company has found no breach of U.S. sanctions. The review came after a report in the Financial Times that Iran was covertly moving money around the world using accounts held by Santander and elsewhere. Now, in other news, Bloomberg has learned that Standard Chartered is considering restructuring its institutional banking arm. Now, the revamp would be the latest effort by the chief executive, Bill Winters, to improve returns. Now, a spokesman for the lender declined to comment, but Tom Metcalf, who's been spearheading that team, Bloomberg's managing editor for finance and investing in EMEA, joins us now. So, Tom, this is a pretty exciting scoop because it kind of gives it a little bit of an insight on what the chief executive of Standard Chartered could be looking at. So what are his options?
Yeah, exactly. It's what's going on behind the scenes. Bank's obviously preparing for its fourth quarter earnings, February the 23rd. So we're expecting more stuff along these lines perhaps leak out. And this is an interesting option they're apparently considering is right now Standard Chartered has this huge unit, commercial, corporate and investment banking, all headed by Simon Cooper. And what they're apparently, one of the options they're considering is splitting that out a bit, give a bit more visibility on all those business lines. But that would be a big change. As long as I've been covering Standard Chartered, it's had this structure. And it also begs the question of, if they're considering this, what else are they considering?
So what do we know about China?
In terms of...
I mean, what have they said about their operations in China?
Oh, yeah, well, I mean, big area for them. I think it's kind of gone through a difficult period. In terms of that, they're basically, you know, it's going to be key to their results, right? So they really need the China, the Asia markets to be far in. That's how this bank works, basically. And, you know, the sense is, you know, if that goes wrong, they really need to look pretty deep to sort of make it work.
So, I mean, when you look at earnings, of course, as you say, on the 23rd, a lot of it will be on this possible restructuring. I mean, do they have a valuation problem, given how much money they make? That, I mean, what would be the rationale of splitting up these two groups?
Yeah, no, well, certainly expecting this all to be announced. As I say, they might change, you know, nothing's been decided, so they might come out with something new. And I think the rationale is, you look at the share price, you know, under Winters, it's dropped something like 40% since he took over in 2015. Mm-hmm. So you can see why investors might be starting to lose patience. You know, they've gone through now a high interest rate environment, haven't really seen that jump in the share price yet. So the interesting thing for me is this change is not that drastic. It sounds drastic, but it's effectively, you know, just splitting things up within the same overall bank, right? Whereas I think some investors looking at their share price might be pushing for something more drastic.
Tom, thank you so much. As always, Tom Metcalf, they're in charge of finance and investing in EMEA. Now, Lyft shares are rallying pre-market, although nowhere near the 67% surge in extended trading. Well, the ride-hailing company issued a massive correction to its margin outlook, saying it expects growth of 50 basis points this year, not the 500 basis points in an earlier press release. Now, the rival to Uber sees first quarter gross bookings of up to $3.6 billion, beating estimates for just under 3.5. Let's bring in Bloomberg's Alex Webb. Alex, I mean, I kind of read it 5 times yesterday. I was like, wait, what? 67% higher for the stock because of a number error.
Yeah, I mean, yesterday we were talking about ASML decline because of a fat finger trade, potentially. This kind of looks like a similar thing, actually, with a fat finger on a keyboard. They're attributing it to a clerical error. They said they were expecting the margins to increase by 500 basis points. Half an hour later, they went, oh, whoops, no, sorry, 50 basis points. Clearly, you know, a factor of 10 smaller. It's embarrassing, obviously. Yeah. The share price had this huge boost, and after hours, it's come down quite considerably. It doesn't, someone quoted in the story a lawyer saying, it doesn't necessarily look like it's securities fraud. It's a mistake. Yeah. Humans make mistakes. The stock is still trading up, which seems to reflect the numbers are indeed getting better.
Let's move on to Amazon now. I'm quite fascinated by this because Jeff Bezos sold a lot of stock. I mean, he sold like $4 billion worth of stock in just 4 days.
Yeah, there's some speculation this is to do with his move to Florida, where the tax in Florida on corporate gains or capital gains, I should say, sorry, is quite a lot lower. Yeah. Non-existent compared to Washington, to Seattle, where he was living previously. So this enables him to do that. He's never bought Amazon stock since he's founded the company. With the stock on a bit of a tear this year, a bit of a rally, it's presumably a good moment. He has lots of other things he can spend his money in, not least Blue Origin, which has gone through a few of its own problems, maybe needs some capital. We don't know how he's going to spend the money, but it's, with a company like Amazon, it's a big amount of money for any individual. For Amazon itself, it's a small slice.
NVIDIA also now overtaking Amazon as one of the biggest, market cap in the AI rally. What does it tell you about what NVIDIA does next?
Well, we've got earnings coming up next week, I think, and this is going to be, as ever, with these hugely sort of overbid stocks, like they need to sort of beat expectations in order to meet expectations, essentially. The expectations are sky high. In fact, if you look at the share price, it's just been consistently overtaking the 12-month target price. Like, analysts just can't keep up in terms of where they think the stock is going to go. They've all been consistently having to upgrade, or feeling they have to upgrade, in order to predict accurately where the company's going. So there are sky-high expectations. We have seen a few instances of where companies have fallen just ever so slightly short. You think about Microsoft a few weeks ago, and they've taken a little bit of a hit as a consequence. But so far, NVIDIA has you know, since ChatGPT was released a year and a bit ago, it's consistently exceeded what investors are expecting.
Alex, thanks so much. Alex Webb there with the very latest on some of these really great companies that we follow day in, day out. Coming up, commercial real estate going through a shakeout in parts of the U.S., but just how far will the contagion spread? We'll have more on that story next, and this is Bloomberg. Shares rose as much as 4% earlier after their earnings, setting their operating targets for 2024. Now, the chief executive, Veitmane, told Bloomberg he's confident about the recovery this year, driven notably by the opportunities in AI. Well, he spoke with Bloomberg's Anna Edwards and Kriti Gupta from Paris.
We're seeing now the trough in Q1, and we expect from there to start to see a recovery overall from a growth perspective as we go through the year, with a pretty good exit rate in 2024. Basically setting up for a return to pretty solid growth in 2025. And I think probably that's what the market is appreciating, is the fact that we expect to see the trough in Q1 and from there to see the recovery through the year.
What gives you the confidence in that trough in the first quarter, as you describe it, Eamon? I mean, is this to do with your expectations around companies spending on IT and spending on consultancy? Do you see them more and more willing to do that after the first quarter?
So first, we see our pipeline. You know, we ended up as well with a pretty solid, bookings in Q4. We see the budgets that clients have planned for 2024, the discussion we have with them, and then we see the number of projects that will start or are starting, in the next couple of quarters. That's what gives us the confidence, is we expect the investment cycle to come back. Number of, some industries like financial services have cut to the bone around some of the tech costs, and we see them to, starting probably in Q2, Q3, to start to unlock more budget because they have to make some of this investment to continue their digital transformation. So we continue to see positive traction. And we see new areas, for example, around sustainability. We have developed quite a bit of offerings, and we launched around climate tech last year. And now, for example, we're involved in a number of gigafactory scale-up across the world, not just in Europe. And of course, this is new business that's coming in that will scale over time. You haven't yet opened the subject on Gen AI, but the Gen AI discussion are opening a lot of discussion around transformation across the firm, which again, setting up for a number of new potential projects that we see coming through the year.
When does all this AI investment, with whichever partners you choose, actually pay off? There's a question of whether this is a 12-month story or a 10-year story. When do we start to see the investment pay off?
So there have been some quick payoffs in some areas. The most worked out example is the famous call center example, productivity, and people have seen, improvement quite quickly. In some others, it's going to take more time, because it's not just about developing a nice algorithm that basically enables you to make decisions faster. It's how you take that at scale in your company. What do you need to change is target operating model, in KPI, reskilling people, changing processes. So some of it is hard work, but this is also what's going to bring the much bigger payback. We will see, acceleration in R&D development cycle, how to innovate and to be able, to design and produce cars much faster. Same thing around R&D in pharma. There's a lot of innovation around, how do you increase the hit rate around molecules, and how from there to be able to bring, products to market much faster from a drug perspective, and to be able to address, smaller diseases where initially people would not put the money on the table to be able to go after them. So there's many, many areas across the value chain of firms.
Well, that was Ayman Ezzat, the Chief Executive Officer of Capgemini, speaking to Anna and Kriti on the back of their earnings earlier this morning. Now, commercial real estate looks to be in crisis in many countries, with blow-ups from New York to Sweden and, of course, Germany. But there are concerns that contagion could spread, putting a black hole into the balance sheets of major financial institutions. Now, European bank executives and even the German finance minister have been looking to reassure investors about the health of Europe's commercial real estate sector.
If I take the global balance sheet of the group, we have around 500 billion euros of real estate exposure, but it's almost only made of home loans to French and European citizens. So it's definitely not an issue of commercial real estate, fancy commercial real estate in difficult areas.
Our expectation is that in this sector, maintaining a strong focus of attention, obviously, but we do not be in a position to have a negative surprise during 2024.
From all what I have known, the market as a whole is stable, unless there is a need for new priorities and to rearrange projects due to the higher interest rates.
Well, joining us now is Bloomberg's Jack Sitters, our resident expert on everything real estate, especially commercial real estate. Jack, we've been talking about this for, 18 months, but frankly, it feels like 5 years. So why has it taken so long to actually get here?
Yeah, well, so I guess, unlike most of what you spent the day talking about, real estate is not traded on a screen. Yeah. It's inherently illiquid. It takes months, even years to sell it. So a quick recap, what's happened. Obviously, we had Russia's invasion of Ukraine, interest rate hike, inevitably risk-free rates gone up, so returns required from property accordingly go up. And what that means is sellers are clinging to their backward-looking valuations, which are based on previous transactions. Buyers want to pay a new price that reflects where the risk-free rate is. So huge, big bid-ask spread opens up, no deals. Valuations are based on transactional evidence, so they're very, very slow to adjust. This has been dragging out now, as you say, for like the last 18 months. But gradually, as time goes on, loans mature, people have to refinance, funds hit the end of their life, they have to sell assets, and you get that drip, drip, drip of transactions. And what we're starting to see is those transactions are at materially lower prices than where they were before, understandably. And eventually, banks have to acknowledge what that means is there's going to be some impairment in their real estate loan book. So that's where we are now. Banks are starting to provision for expected losses.
But Jack, so how big are these provisions? Like, again, do we fully have an understanding of the exposure of who to what? Or could it turn ugly quite quickly?
So, no, we don't have a perfect picture. I think, as ever with real estate, it's worth bearing in mind it's an inherently local asset class. And the sort of worst part of the market globally right now is the US office market. Also, the US has the most transparent debt market. So we have a reasonable sense of who's exposed to US office in particular. I guess what's been interesting recently is that's not just US lenders, that's European lenders, Japanese lenders. So there's risk of spread there. What we don't have yet is a real sense of how significant the hit to lenders could be in Europe. We've had individual isolated events. Signa, the big Austrian luxury group, has collapsed. Julius Baer has written off its entire exposure there. But there could be more to come.
So, Jack, is this mainly basically because of the link to U.S. commercial real estate, or is this commercial real estate in Europe that then needs to be provisioned?
So I think there's two separate things. I think a lot of the headlines we've seen in the last couple of weeks have been around exposure to U.S. commercial real estate. And I think, as I said, we have to bear in mind that the operating environment of the US and Europe are very different. Vacancy rates in the US office market are very high. In Europe, they're rising a bit, but from a much, much lower base, so not the same concerns. But we do know that, bond yields, gilt yields have moved out substantially over the last couple of years, and real estate prices have not yet corrected to the extent that reflects that. Now, will they fully move in lockstep? We'll see. But if they do, inevitably, there is going to be more distress for European lenders.
Jack, as always, thank you so much. This is really the topic du jour. Jack Sitters there with the very latest on commercial real estate. Up next, Bloomberg Brief, Danny Berger and Manus Karani in New York. They'll also be speaking about the energy markets. This is Bloomberg.